of financial crisis recovery.
Foreclosure, short sales, bankruptcy, credit card debt, job loss, depreciating home values, money management. Peace of mind when it comes to your finances seems completely out of reach under current conditions, but there is a way to achieve it. For the next 60 minutes, you're going to find out how to cover your assets. Cover your assets. Now, here's nationally renowned speaker and expert on getting you on the path to financial strength, Todd Rooker.
Well, good morning and welcome to Cover Your Assets. Hopefully some of you are transitioning from Jason Walgrave and Mike Overson's show, Minnesota Home Talk. And if you had any questions that you didn't get answered on the last hour, then by all means call in to our show. Jason and I and Mike kind of own the airwaves on ESPN from 7 to 8 and 8 to 9, and we're pretty proud of that. So always feel free to do that. Our show today, Cover Your Assets, which is the idea of positioning yourself to be in a strong financial position or to ensure that if you are in a compromised position, how to deal with it, how to recover, and get back on your feet quickly. So the topic of our show today is going to be how to position yourself for future financing. I teach a class for Kaplan Professional Schools, which is one of our sponsors. Very proud I am to have Kaplan Professional Schools as a sponsor of our radio show. One of the classes that consumers can attend, although it is generally created for folks who need continuing education, who are in the professions of CPA, financial advisor, mortgage broker, real estate agent. These are classes that the general public can attend, and they can be enormously beneficial, kind of getting the inside and insight as to how things work. That class that I'm describing is called Strategic Default and the Path Back. And the path back is really all about how to position yourself for future financing. Because if I'm going to go through a financially challenged position and I say to somebody like, Todd Rooker, hey, look, Todd, tell me, how do I recover? How long will it take me to recover? What you're really asking, more than likely, although you may not understand it at the time, is really how long will it take me until I can qualify to refinance my house, buy a new house, qualify for car financing? How long until the cost of my car insurance that doubled goes down? So when you're talking about those things, the answer to the question of how long does it take me to recover is really underwriting guidelines that limits or eliminates your ability to qualify for financing in the future. So the concept of positioning yourself for future financing is really all about understanding underwriting guidelines and morphing yourself into a situation where you go and submit a file to a financial individual such as Mike Overson, and he submits that through an automated underwriting model. What you'd love to see happen is an approve without kicking it back to a manual underwriter who's going to then ask Mike for endless stipulations to close, and it goes on and on for months and months and months, and you talk to the guy down the street and you don't understand how come he was able to close in 7 days. Well, he went through the manual underwrite and kaboom, he got an approve, you got a reject, or you got an accept with a ton of stipulations. And the reason is because you've got this and this and this. And while your credit may be good enough in terms of the threshold that is required to qualify for the program, you may have multitudes of other issues that are causing that problem. So when people go to see somebody for financing, I've always found it interesting that when they, go out dating, they try, or at least attempt, to make themselves look attractive to the individual that they're dating or going out with, seeking a spouse or what have you. But when they go to ask for $200,000, $300,000, $500,000, they don't know how to make themselves look attractive, much less position themselves for that financing. And it generally comes down to dumping their crap on a banker's desk or a loan originator's desk and saying, can I close by Friday, and having no concept of what it actually takes to get that financing. And had they known that 2 or 3 years ago, they could have been in a fabulous position to be able to finance a home or a car, but they had no notion of what those underwriting guidelines are. So we're going to be talking about that today. So, Mike, what do you think about the topic? It's right up your alley, isn't it?
It is right up my alley, and it's, there's the mortgage game, and I call it a game just because a lot of it is automated in today's world. So it's just like credit. You need to know how that automated underwriting system works, what to plug into it, what not to plug into it, and by knowing how it works and it functions, then you can kind of figure out what it likes, what it doesn't like, and then put it in the best light or put your situation in the best light for it so that it will approve you. And once that automated system approves you, it's a lot easier to get to closing versus going to a manual underwrite like you were talking about earlier.
The problem with that, and it is something that is typically referred to as structured loans, the problem with that, and Mike has a program called Path to Buy. I've got a program, DVD series called Path to Financial Strength. So we've all got a path to somewhere, I guess, you know. But the Path to Buy is the notion that you sit down and go through your deficiencies. And even though you may not be able to qualify today, how do I position myself to do it? Now, I'm going to tell you, I've got almost 30 years experience helping people go through these financially challenged issues. And one of the biggest problems with that is that the mortgage industry, forgive me for saying, is an attention deficit industry in that those folks are on commission. They need to make an income. They need to close a loan or they're not going to be able to make their own house payment. So what tends to happen is you rarely find somebody like Mike who will actually take the time to sit down with you, because the bottom line is if you can't close by the end of the week, end of the month, it goes on the pile with all the other ones, and we close the ones that we can close the end of the week, the end of the month. And then when we got nothing else to do, then and only then do we look at those files. And so the idea of putting forth as a mortgage broker in a tough environment, trying to get loans through, and I think Mike will agree that what it takes to get a loan through today is tenfold what it used to be. It used to be, hey, man, you can fog a mirror, you can get a loan, right?
Pretty much.
Yeah, man.
Yeah.
So today, they really have their hands full. When you go to somebody like Mike, and is willing to take the time to sit down with you and say, yeah, you're right, you got a short sale. And that may be a 2 or 3 year timeline, depending on circumstance. But the other issue that you've got is you've got these collections out here. You don't have a single active trade line. You've got a multitude of other things. And even though the time of 2 or 3 years will come and go, when you sit down with me 2 or 3 years from now, believing that now that you've gotten far enough away from this particular issue, and that could be short sale, bankruptcy, foreclosure, some of the issues we talked on the previous show, Minnesota Home Talk, that doesn't mean you're getting a loan, does it, Mike?
No.
You still got other problems, right?
There's so many factors that an underwriter looks at now. And just to give an example of how much the mortgage industry has changed, in 2007, there was 775,000 loan originators throughout the nation. Right now, there's about 115,000 loan originators that are registered with the NMLS right now. So we're talking, what is that? About a 17%.
Yeah.
So we're talking there's 83% less loan originators now than was in 07. Back when I started the mortgage industry back in 04, I needed 12 sheets of paper signed by a borrower to start a loan. Right now for FHA, I need 45.
Unreal.
So that's the change that has happened over the last, 5, 6, 7 years in the mortgage industry. And things have gotten tighter. Some things have gotten a little bit looser, but for the most part, that box has gotten smaller, and now you need to know how to fit into that box so that you can get a loan.
Well, you bring an interesting point up. Wade Ahmed, and who is a sponsor on your show, Minnesota Home Talk, and hopefully will be a sponsor on our show soon as well, was the president of the Mortgage Broker Association for MAMBI, and I was on the educational committee, and we watched, if I'm not mistaken, 2006 or 2007, when they instituted all the guidelines, we watched literally 3/4 of the mortgage brokers in Minnesota non-renew their licenses in that 1 year. So, the loans are tougher to do, but the water line, meaning the number of folks who are practitioners in the business, is significantly fewer. One reason is because of the new requirements for continuing education. Soon, probably, we're going to have comprehensive testing for mortgage brokers, which frankly is a travesty that we don't yet. But then there's also the bonding issues, and that got rid of all the folks who thought they were going to get their clients at the bars on Friday night. Didn't
right.
it? Yeah. You really do have to be a professional today. The chaff has been sifted to the bottom, and the people who are left standing are good mortgage brokers. But when the market is ticked up, they've got more business than they know what to do with, and they've got to focus on the loans that they can do in a reasonably short period of time. So for you, the consumer, you need to be conscious of this, and you need to realize that the onus is somewhat on you, and you need to get the questions answered. And whenever you go into a consultation with somebody who's trying to make a living, you should be aware that you walk into a meeting like that with somebody who really has the insight and the knowledge, and you want to make certain that you have pointed questions so that you can actually have a productive meeting. You sit down, you ask these pointed questions. And by goodness, whether you're a note taker or not, you become one that day. You do not show up without a notebook. You take a lot of notes, and you let them tell you. Mike says, you're deficient here, you're deficient here. You need to have this, you need to have this. And so if the crystal ball was 3 years in advance, what do I need to look like, Mike, in 3 years to be able to get a loan? And Mike says, well, you're going to have 2 years worth of history on these trade lines. You don't have any trade lines right now. You want to make certain that you don't go changing your profession during that period of time, because we're going to need 36 months worth of time and occupation, and we need to be able to string those two together. We can't have any gaps in employment during that period of time, and on and on and on, right?
Yeah.
And people are completely clueless as it comes to this. And I see people who are losing, $1 million homes. They're forced to walk back into something that they are not exactly excited about, which may be a $1,500 per month rental. And because their ego is beaten and bruised, they go buy themselves an Escalade and a BMW because they still have reasonable income. They have virtually no payment as compared with before. They couldn't afford the $5,000 a month, but $1,500 is no problem. But the problem now is they've got two big fat car payments that are $700-800 or more per month, and that eliminated their ability to qualify for financing on a house that's anywhere near what they want to be able to buy.
Right.
Do you see that as well?
Yeah, I see that all the time. And the debt to income ratio, I mean, I see both sides of the spectrum. I see people who are ultra conservative and play the safe route and, spend maybe 20% of their income on their house, and that's all they want to spend, which is great. Frees up a lot of money for them to do other things. And then there's the people that just want to max it out. They come to me and say, what can I get? And I'll say, well, I mean, FHA will allow you to go up to this amount here, which is when you take house debt plus any other debt, the FHA will allow up to 56.5% of your income to go towards your house plus the payments that show up on your credit report. So, they'll come.
So ESP and listeners, did you just hear that? 50% of your gross income. That is not your take-home pay. Now, of course, Mike, I know that's assuming that you don't have any other debt, because that's overall DTI.
Right.
But as opposed to payment to gross, which is a different formula. But listen, if your kid comes out of college and he tells you that he qualifies for a house that is 56% of his $45,000 per year gross income, eaten up in principal, interest, taxes, and insurance, if you're a parent and you don't lose your mind when your kid tells you they're going to do that, then you need to have your head examined.
Right.
So here's the point. Just because you can qualify for the loan doesn't mean you can afford to make the payment.
That's exactly right. And I tell people that all the time. It's like, hey, look, you can go up to this high if you want to. I don't recommend that. Here's what I recommend, and I try to stick to around the 31-43 principle, where 31% or less of your total gross income